Good morning, everyone. Hello. This morning, we're going to talk about one of the most important financial statements, the cash flow statement. How to prepare a cash flow statement. You know that we have four basic financial statements: the income statement, the balance sheet, the equity statement, and the cash flow statement. And of the four, cash flow statement is by far the most important financial statement to the investing community, to the financial analysts, to the market. Overall, it is very hard to rank the importance of these financial statements, but surveys time and time again have proven that cash flow statement is the most popular in the market. All right. How do we prepare a financial how do we prepare the cash flow statement? Cash flow statement is based on the cash principle, cash concept, whereas the income statement is based on accrual principle. You know that accrual principle is one of the bedrocks of financial accounting. We have long ago, it's been a while that we have moved away from cash-based accounting, but cash flow statement is still is still creating the most appeal to the users of financial information. And the reason is actually finance. The reason is this valuation, is its importance in valuation. Because we know that the value of an asset is the present value of all future cash flows generated by the asset. So be it a stock, a bond, a business, a land, a house, your job, any asset, tangible or intangible, financial, non-financial, the value of an asset is the present value of future cash flows generated by the asset. So for a company, for example, it has to be the case. For stocks, we have the most popular or the most sound valuation models include the free cash flow model, the free cash flow from equity, or the free cash flow to the firm. So, whatever way you calculate free cash flow or cash flows, you have to resort to the cash flow statement. Anyway, so how do we prepare the cash flow statement is the objective of this presentation. All right, so this presentation is primarily for my construction management students at Alabama A&M University, CMG 400. Hello, guys. So I hope you find it useful, because for the construction managers, for engineers, one of the tools we use is cash flow statement. So for your construction project or for the firm as a whole, we need to learn how to prepare the cash flow statement before we use it. All right, so I'm going to do screen share, and you have seen that I moved away from showing these handwritten slides, but I'm going to show some today as well, but I'll primarily use my screen share facilities. And you can see here I am. So we start with this slide, how to prepare a financial, how to prepare a cash flow statement. And there we go. You can see cash flow statement. We say it provides useful information about a company's ability to generate cash flows from buying and selling goods and services, like from day-to-day activities, finance growth, your ability to finance growth, and your ability to meet your financial obligations and pay dividends. So these are the highlights, but the main point is that the cash flow statement shows you a whole host of information, provides you a whole range of information that you can use to assess the company's ability to see how the company is doing, what the blood circulation it is having. By blood circulation, we mean that cash is considered to be the blood supply, the lifeblood of a business. Well, so we need cash to survive, to meet our day-to-day obligations, to actually operate smoothly and then to finance growth or to pay off our debt. It has three sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So three: operating, investing, financing. All right, three sections. Here is a scheme. You can see the cash inflows and outflows for for the operating activities section. The inflows include money received from customers, like money received from sale of goods and services. And then outflows include all your operating expenses, like money paid to pay rent, to purchase goods, like cost of goods sold, to pay your suppliers, to pay your employees, to pay for insurance, to pay for utilities, to pay for all day-to-day recurring expenses, operating expenses, and including interest expense. Under US GAAP, interest expense is considered to be an operating expense. All right. Then the investing section, the inflows are rare, but still there could be inflows when you sell your investments. If you sell your old asset, any old or existing assets, but it has to be a non-current asset. So sale of inventory creates operating cash flow, but sale of non-current assets, like if I sell my house, if I sell your automobile, if you sell your vehicles, if you sell your old equipment or furniture, then you receive some cash. So that's cash inflow from investing activities. Or if you sell your investments, stocks and bonds, if you have investments in stocks and bonds, or even investments in other businesses, like if you have a subsidiary and you sell your subsidiary, so that would be an inflow of cash from investing activities. But investing activities section, generally we see outflows because most businesses for up to a certain period are growing, constantly growing. So for new businesses to, say businesses who are not fully saturated, you will see investing section showing a negative cash flow, like more outflows than inflows. What the outflows are? The outflows include money invested in, again, non-current assets, invested in land, building, equipment, furniture, um, all sorts of appliances, or investments in stocks and bonds, or investments in new acquisitions. So, in the US or even in Asia nowadays, we have a lot of acquisition activities, M&A activities going on. So any money spent on acquiring those businesses is considered to be an outflow of outflow of cash, and that would come under the investing section. So that's investing inflows and outflows. Again, inflows come from sale of investments, and those investments don't include just stocks and bonds. And by investments, we mean non-current assets like my equipment, this laptop, your jewelry, your land, your building, your all non-current assets. And then, so what do? We, typical households, we don't always sell our homes, but most households buy their homes. Most households buy vehicles. So even at an individual level or family levels, we see investing activities to see more outflows than inflows. Finally, the financing section, cash inflows from financing include money received from sale of stocks and bonds. Like by sale, we mean issue of stocks, issue of bonds, or obtaining new loans. These three, and any like new loans, new preferred stock, new common stock. So money received from those financing activities, like in any way we raise money to for the long run. So money received from day-to-day activities is operating, but money received from borrowing or from selling our equity or from like selling bonds, obtaining new loans, these are all inflows from financing activities. And the outflows include payment of dividend, most commonly, or stock repurchase. So many companies, especially in the US, is very common and popular to buy back your shares. So if you buy back your stock, that's an outflow of financing. That's a financing outflow. If you pay dividend, as I said, and pay preferred dividend, pay common dividend, these are all outflows, or paying down your debt, repayment of loans. So that's also an outflow of financing or financing outflow. All right, so these are the activities. So I already explained these. You can see cash coming in and going out. from buying and selling commodities and services, paying salaries, wages, insurance, utilities, and paying interest. So these are cash flows from operating activities. I've included mostly most of the major ones, both the inflows and outflows. You can see buying and selling commodities and services. Like when you buy commodities and services, there's an outflow, you pay your suppliers. But when you sell your commodities and services, there's an inflow. And then most other items are outflows. Then in the financing investing section, which I've already, I was ahead of me, buying and selling fixed assets such as land, building, equipment, and intangibles. So I don't want to repeat. Financing, cash coming in and going out from buying and selling companies own stocks and bonds, borrowing, paying dividend. You can see. So here's how we report it. You can see these are all hypothetical numbers. So you report cash flows from operating activities, then investing, and then financing. So all three together, for example, the net cash inflow here was $400. We have received $200 from operating activities. Then we had an outflow, net outflow of 300 from finance investing, and then 500 came in from financing. So total inflows were $700 and outflows were $300. So net cash inflow was $400, and that should be equivalent. That should explain the change in cash. So our beginning cash balance, or end of last year, our cash balance was $100, and end of this year, cash balance is $500. So that shows, that means the change in cash was $400, and that's exactly equal to our net cash inflow. So if you have net cash inflow, your cash balance should have gone up. If you have net cash outflow, combining all three, excuse me, all three sections, then your cash balance would have gone down. Excuse me. Now we start with the cash flows from operating activities, operating section. And there are two alternative ways in which you can prepare the operating section. Remember, two ways. One is called the direct method, and the other one is called the indirect method. So under the direct method, we start with cash inflows first. So cash received from customers. That's, in most cases, that's the only inflow, cash received from customers. But there could be other operating activities like other income or any other fees, but those fees or other things also would come from your customers. So cash received from sales or non-sale activities, like non-core activities, not non-sale, non-core activities. But for simplicity, we'll have just one inflow here, cash received from customers, and then cash paid to suppliers down to all the other four. These are all outflows. You can see cash paid to suppliers, cash operating expenses paid to employees, like for salaries and wages, then cash paid for insurance, rent, interest, taxes, and utilities, any head of expenses. Anything that is a routine activity, except for depreciation, of course. So we don't include any non-cash activities here. We include only the cash activities, the ones that we met in cash. All right. Now, each one of these require a formula or a method of calculating, like how do we know how much cash we paid to suppliers or how much we received from our customers. So I start with the first one, cash received from customers. The formula or the way to calculate it is that you have your credit sales, and if credit and cash sales are not distinguished, then take the complete sales, total sales. So, but if cash and credit is available, cash credit distinction is available, then of course cash sales is cash. So that would be base amount plus this. So credit sales, in this case, I assumed it to be $3,000. Credit sales plus decrease in accounts receivable or minus increase in it. So don't have the two at a time. Either you have increase in receivables or you will have decreases in receivables. Well, so why is that? So in this case, for example, if you just had the decrease, of course, if you had, as I said, if you have decrease, you can't have increase, and vice versa. Well, so our credit sales was $3,000 and decrease in receivables was $500. So that makes it $3,500 of cash received from customers. Now, why decrease in accounts receivable is added? Let me show you something here. No, sorry, I don't have it. So let's look at, let's go back to that credit sales example. So if you have, for example, if credit sales was $3,000, and then let's say your beginning accounts receivable was $1,000. So you already started the year with $1,000 of accounts receivable, which is the money that you would be trying to collect. So you have $1,000 of receivables, and then you've made another $3,000 of sales, credit sales. So your total money outstanding with customers is going to be $4,000. Can you see it? You have started with $1,000 already in the market with your customers, plus you made credit sales of $3,000. So total amount due from customers is $4,000. And let's say at the end of the year, your accounts receivable balance is now only, say, $200. So you have done great job. You've done a great job in reducing the accounts receivable and controlling accounts receivable. And you've not only maintained a steady amount of receivables, you've actually reduced it, almost cut it down by 80%. So $1,000 worth of accounts receivable has now become only 200. That means you not only collected your annual sales, but you collected some of your old accounts receivables. So total of $4,000 was due, and now only $200 is out in the market. So 4,000 minus 200 would have given you $3,800. So an easier way of doing the same is that our credit sales of $3,000 plus decrease in accounts receivable would be $800, isn't it? Because your receivable was $1,000, now it is only $200. So it has decreased by $800. So $800 would be added to your credit sales to make it a total collection from customers of $3,800. I hope it's clear to you. If not, then let's try. Let me show you something here. Let's say your beginning accounts receivable was, as I said, was $1,000 plus sales credit sales was $3,000. So total due is $4,000. Try to see if you can see it. Total due is $4,000. So now, of the total due, your ending balance or closing balance of accounts receivable is, say, only $200. So you have collected how much? $3,800. So beginning balance plus sales is your total due, minus ending balance, closing balance is amount collected, $3,800. Now I can solve it in a much easier way, is that I can say cash collected from customers is my credit sales or sales, which is $3,000 plus decrease in AR of $800. You can see, so that also gives me $3,800. Which one's is easier? Which one's easier? You can see your credit sales of $3,000 plus decrease in accounts receivable of $800. So that makes it up to $3,800. Also do this ledger. You can say beginning balance plus sales is total due minus ending balance is amount collected. So in both ways, it has to end up with the same amount of money. All right, so I prefer this, that cash received from customers would be credit sales, cash sales, of course, if there is it, if there's given. So cash sales plus credit sales plus decrease in accounts receivable or minus increase in accounts receivable, increase in it. So as I said, it will either increase or decrease. So if it decreases, add it. If it increases, then subtract it. The reason decrease should be added is that decrease in AR means we made more collections than we sold, isn't it? Let's say you didn't sell anything throughout the year, but you still collected $800. So even without selling, if you can make collections, that means you have been receiving money from customers, and then you've received what you sold. All right. So decrease in accounts receivable is a good thing from cash conservation point of view. From the cash guy, the financial controller would love it when you decrease your accounts receivable without hurting sales, of course, without hurting sales. All right. Next is cash paid to suppliers for purchases. Now, cash paid for purchases or cash paid to suppliers is a tricky item because the way income statements are produced these days is that we don't have the purchase amount. We don't use the periodic method. In most cases, we use the perpetual method, and the perpetual method calculates cost of goods sold straight away. It doesn't give us the purchase figure necessarily. It doesn't necessarily give us the purchase number, purchase amount. The periodic method, the periodic inventory method would, because under the periodic method, we keep track of purchases, we keep track of our beginning inventory and ending inventory because we do physical stock take. But under the perpetual method, we do not need to have a periodic stock take because every time we make a sale, we, as I said in those videos, every time we make a sale, we have two journal entries, one for the sale and the other for cost of goods sold. So as you sell, by the time you finish your year, you already know your cost of goods sold. So you know your cost of goods sold for every day, for every week, every month and quarter. All right. So that's why from cost of goods sold, we need to work backwards or do some forensic accounting or backtracking and find out our purchases, because we don't pay for cost of goods sold, we pay for purchases. That's why purchase number, purchase information is critical. All right. So what I did is that we use the cost of goods sold information to end up with purchases, and then we use purchases to find out our payment. All right. So we start here. You can see we do our credit purchase plus decrease in accounts payable. So this is to find out our amount paid. But where do I find my purchases? This is the cash paid to purchases formula. That's true. My credit purchase, or if cash or credit is not separately given, then use all purchases. So your purchases of $2,000 plus decrease in accounts payable. Decrease in accounts payable is added like in the previous formula, we added decrease. Remember, added decrease in accounts receivable. Now, decrease in accounts payable is added. Why? Decrease in accounts payable is added because decrease means we made more payments. If you make more payments than your purchases, then your accounts payable balance would gradually decrease. Means the amount you owe to the market would gradually go down. Can you see it? All right. But the trouble is this purchase figure is not available in a typical income statement based on the perpetual inventory system. So what we do, we use this formula first. So we do this one first and then go back and find out the cash paid for purchases. What we do, we have our cost of goods sold. Like in this case, our sales were $3,000, but our cost of goods sold I assumed to be $2,000. So let's say my cost of goods sold were $2,000, and then plus increase in inventory here. Do not add decrease. For this formula, add increase in inventory or minus decrease in it. So why inventory increase is added? Inventory increase is added because it shows that my purchases are more than my cost of goods sold. You see my point? Say I have been purchasing at the same time I have been selling. So if I purchase more than what I sell, then my inventory level would go up. Inventory would build. There'd be a pile up. It would pile up. So that's what happened here. Our cost of goods sold was $2,000, but our inventory level has gone up by $300. That means we made total purchase of $2,300. So cost of goods sold may be $2,000, but our purchase was actually more. Purchase was $2,300. So once you know your purchases, then you go back one slide, and then here you say, make your purchases to be whatever it is, $2,300 or $2,000, and then now add any decrease in accounts payable. So you can see we have three stations here. We have the cost of goods sold, and then purchases, and then payment. See carefully. So three things. We start with cost of goods sold. Using cost of goods sold, we get to purchases, and using purchases, we get to payment for purchases or payment to suppliers. How we do that? So with cost of goods sold, we add any increase. We add increase in purchases, increase in inventory, to get to purchases. So cost of goods sold plus increase in inventory or decrease in it. Correct. So cost of goods sold plus increase in inventory, that would give you your amount of purchases. So say purchases of $2,300. Remember, our cost of goods sold was $2,000 and our increase in inventory was say $300. So our purchases were actually more $2,300. And that with purchases, let's say we paid all our purchases and then we not only paid for the current purchases, we actually paid off some of our old payables. So that means our payable level would go down. So here your payment would be $2,300 plus any decrease in accounts payable. So here we increase in inventory, we add increase in inventory, but here we add decrease in accounts payable. So that means you'll be making more payments than not only your cost of goods sold, but then your purchases as well. So slow down. What I want you to remember is that cost of goods sold cannot be directly used in the cash flow statement. We need to find out our purchases. So when you say cost of goods sold, please make sure that you use cost of goods sold or you make inventory adjustments to find out your purchases. And once you have purchases, then make the accounts payable adjustments. Because cost of goods sold is related to inventory. Remember the cost of goods sold formula, you have beginning inventory plus purchases minus ending inventory to get to cost of goods sold. What's the formula in cost accounting? Beginning inventory plus purchases gives you cost of goods available for sale, and then minus ending inventory gives you cost of goods sold. So now if I give you cost of goods sold and the two inventories, beginning and ending inventories, you can work back and forth to find out your purchases. I'm going to show you soon. So once you know your purchases, now you do the accounts payable adjustments to find out your payment for purchases. All right, so let's do the screen share again. Here you see that. Yeah, look at this. Finding out purchases from COGS. So we have, this is my standard sequence of the cost of goods sold statement. So we start with beginning inventory plus purchases gives us COGS, cost of goods available for sale. But my purchase number was missing, wasn't it? I knew my beginning inventory and ending inventory and my cost of goods sold. I know the two inventories from the balance sheet and cost of goods sold from the income statement. But I don't know purchases. I don't have any clue. Right. So beginning inventory plus purchases is missing, but that means cost of goods sold available for sale is also going to be missing. So COGS is missing, but ending inventory is available. So minus ending inventory gives you cost of goods sold. So now please work backwards. So if your cost of goods sold is $2,000, and if something was subtracted from something to get to 2,000, then that something must have been $2,500. So that must have been $2,500. So now we have our cost of goods available for sale, and then from cost of goods available for sale, something was added to something to get to $2,500. So how much was that missing number? That must have been $2,300. You can see now it all makes sense. See, your beginning inventory was $200 plus purchases of $2,300 makes it $2,500 for COGS, and then minus the ending inventory of $500 is your cost of goods sold. But the shortcut is much easier because I'd start with cost of goods sold now, and then look at the change in my inventory. Change in inventory was $300 positive. Like beginning was 200, ending was 500, so it has increased by $300. So simply add the increase. Cost of goods sold plus increase gives you purchase number. Why plus increase? Because you must have purchased more, otherwise your inventory would not have gone up. See, let's say I sell these t-shirts, shirts. Now, if my beginning inventory was say a dozen, and I was buying say 100 dozens and sold 100 dozens, I bought 100 dozen during the year and sold 100 dozen during the year too, then my beginning inventory would be the same as my ending inventory. But what if my beginning inventory is a dozen, but my ending inventory is 3 dozens? 3 dozen shirts. So that would mean that I must have bought more than I sold, than what I sold. I sold, say, 100 dozens. That means I must have bought 102 dozens. Otherwise, my inventory could not have gone up from a dozen to 3 dozens. So we don't use this. We use the increase decrease formula. So we use this one. We use this. Start with cost of goods sold if purchase number is not given. Start with cost of goods sold, then plus ending inventory, increase in inventory, or minus decrease in it. So it increased. All right. So once you have, so that would give us the purchases. Once you have purchases, then we do accounts payable adjustments, which I left there. This is my accounts payable adjustment to get to my cash paid to suppliers. So this one is going to be plugged in to the cash flow statement under the direct method. The purchase number is not going to be useful. I mean, it's useful, but it's not going to be reported. The cash payment to suppliers is going to be reported. All right. Now, cash operating expenses. Again, this is a cash flow statement, so we have no room for the non-cash items like depreciation, amortization, impairments, write-offs. There is no room for those appreciation or depreciation in those inventory or appreciation in the value of anything, in stocks, bonds, investments, or in our fixed assets or non-current assets. All right. So depreciation is, of course, a non-cash item, is a non-cash expense, and there are other non-cash expenses like amortization, write-offs, impairments. None of those, or depletion, none of those are going to be included in the cash flow statement. All right, so we look at cash operating expenses like as it appears in the income statement. So let's say your salary expense. Salary expense is a cash operating expense, means we pay salary in cash, wages, salaries, rent, insurance, utilities, legal fees, audit fees. All these are cash expenses. The suppliers, vendors would probably expect us to pay cash. So first, put the amount as it appears on the income statement, in the income statement. So let's say our operating, all of operating expenses together, except for depreciation and amortization and impairments and write-offs, except for those non-cash expenses, total cash operating expenses is $700. Plus decrease in any accrued expense. Accrued expense decreases when? When does it decrease? When you pay more than you incur, then you accrue. Let's say I buy groceries from your store. So I buy $1,000. I bought $1,000 worth of groceries, and I paid you $1,000. If that happens, would my payable go down at all? No. So let's say I pay rent, and my annual rent is $12,000, but I owed some money to my landlady. So I already owed him $5,000. Then the current year's accrued rent is $12,000. So 12 plus 5, I owe them now $17,000. But if I say I had a great year and I paid off $14,000, $15,000. So see, my regular rent, annual rent is only $12,000, but I paid $15,000. That means I brought down my payable, my rent payable or accrued rent down from $5,000 to only $2,000. But it did involve more cash than my regular expenses. My expenses, accrual expense, is only $12,000. But including my accrued ones, unpaid rent, I owed him $17,000 and I paid off $15,000. So I now owe only $2,000. So that's what is happening here. Cash operating expense plus any decrease in those accrued expenses or expense payable, like salaries payable, interest payable, rent payable. But don't include dividend payable. That's not an operating expense. So it has to be operating expenses, cash operating expenses. But for the purpose of cash flow statement, consider interest expense and operating expense too. I mean, interest expense too as an operating expense. All right, so if we have that, so either it will decrease or increase, both of them won't happen at the same time. So I assumed it to have decreased. So my income statement number is $700 plus decrease was $300. So total cash paid for expenses would be $1,000. So now we have all three. So three so far. We have money received from customers, we have money paid to suppliers, and we have money paid for all our operating expenses. So now if you go item by item, you could do like cash paid to employees, cash paid to utility companies, cash paid to workers as wages, cash paid for income taxes, and cash paid for interest expense. You could do item by item. So let's say we have salary expense and it appears as $700 in the income statement. So it has to be the accrual amount. The beginning amount, the base amount is the accrual amount picked up from the income statement. So salaries expense is $700. That's how it appears in the income statement. And then wages payable or salaries payable has decreased. If it has decreased, then add it. If it has increased, then subtract it. Because if it has increased, that means you conserved your cash. You paid less cash to your employees than you owed them, than you were supposed to, or than you received services for. All right. So if you paid less, then you'd have saved cash, but your liability, accrued salaries or accrued wages balance would have gone up. Anyway, so if it increases, of course, we subtract it, but if it has gone down, then we add it. That means we paid more. Same is, so let's look at it from the change point of view. So wages payable last year was $500 and this year was $200. So look at the first line, first row here. So of course, salaries expenses, the base amount is $700. So wages payable last year was $200, but this year it's $500. So that means it's gone up by $300. So going up means what? Going up means we paid. Sorry, going down. Last year was, my first column was last year. So last year was $500. This year is $200. That means it has gone down by $300. Your wages payable has gone down by $300. So how does a liability go down? Only if you pay. If you pay more, then you incur. So salaries expenses incurred amount is $700, and then I paid some of my old debt, $300. So total cash paid to employees would be $1,000 here. Alternatively, or in contrast, if wages payable has gone up, so last year was $100, this year is $400. It has gone up by $300. That means you paid less cash, or you spent less cash. So salary expense, even though accrual amount is $700, but your cash would be only $400. Because from $700, you financed some of it by not paying him. So your employees are actually financing part of your business. Can you see? They're financing your business by not receiving or not forcing you to pay their wages on time. So here you go. We also, I also showed it using the ledger way. So the beginning wages payable, for example, $500. So let's go back. You can see last year was $500, this year was $200. So the first scenario, last year wages payable was $500, this year is $200. So that means beginning wages payable was $500, then wages salaries accrued was $700. So 7 plus 5 is $1,200, minus ending wages payable is only 2. That means cash paid was $1,000. But much shorter is if we just add the 300. See, if payable goes down, that means this is a good thing. Well, this is a good thing from liabilities point of view, but this is a bad thing from cash flow point of view, because your cash has gone out. See, wages expense was $700, but cash paid was $1,000. All right. And the same, we do the same for cash paid for insurance, interest, income taxes, and any other operating expense, utilities, legal fees, professional fees, rent, anything. Same way, accrual amount plus decrease in that item payable. So say insurance expense of $1,000 plus any decrease in insurance payable. Rent expense of $5,000 plus any decrease in rent payable. So all decreases would be added, means to get rid of those dues or accrued amounts, we would need more cash. That means we paid more cash to get rid of those owings. All right, so that's the direct method. So direct method includes those major formulas or major items. The first one is amount received from customers, cash received from sale, cash received from customers, because sale doesn't necessarily generate cash, the collection does. Well, sale eventually, sale generates revenue, but revenue if not collected, then it's no good. So revenue would be there would be no cash if all my revenues get stuck in accounts receivable. So fortunately, most businesses know that and they combat that accounts receivable. They're quite meticulously and quite judiciously control accounts receivable. All right, so that's number one, cash received from customers. Then number two is cash paid for purchases or cash paid to suppliers, then cash paid to employees, and likewise cash paid for all those expenses except for non-cash expenses. So cash paid for insurance, wages, rent, professional fees, taxes, but not dividend. Remember, dividend is not an operating expense. All right, now we do the same using the indirect method. So the indirect method is much better, much easier, and also more popular. It starts with net income, and for the as the base amount. So the starting point is that we assume that our income statement is based on the cash principle, or there is no change in any payables. So our accrued amount is all paid. So all the sales have been collected, all purchases have been paid for, all wages have been paid for, all rent have been paid for, everything has been paid for. In that case, my net income would be the same as my operating cash flow plus or minus any non-operating item. Or at least I could claim that my operating income EBIT would be the same as my operating cash flow if all purchases were paid for and all sales have been collected for. All right, but it is not the case. So that's why we start with net income, and we know very well that net income is not going to be the same as my operating cash flow. So we need three adjustments to reconcile net income to operating cash flow. How many adjustments? Three basic adjustments. If you elaborate, it would be a lot of items, but three basic adjustments. Which three? Just look at the headline here. The heading is cash flows. So that means it has to be cash. So that means any non-cash item, any non-cash income, non-cash revenue, or non-cash gains, and non-cash expenses, non-cash losses, non-cash items must be cleaned up, must be excluded from net income. So what happens? Net income is affected by cash receipts and payments, but it's also affected by depreciation, impairment, write-offs, and amortizations, isn't it? So a lot of non-cash items go there, and also it is affected by appreciation in the value of trading securities. If you have stocks and bonds in your trading portfolio, then any appreciation in value or non-cash holding gain, what do you call it? Non-cash holding gain means you made money from just holding it without selling. So this is unrealized profit. So all those unrealized profit is profit. In financial accounting, under the accrual method, unrealized profit is also profit. It is insofar as it is concerned, insofar as it concerns trading securities. All right. So what happens? We have to make that, we have to clean it up. So the first cleaning is for non-cash items. Means all non-cash income must be subtracted and non-cash expenses must be added back. So most typically, depreciation must be added back. It's the biggest and the most common, most frequent non-cash expense, most frequent accrual expense. So we add it back, and then we do working capital, going back to that line, it says cash flows from operating activities. So we first clean the non-cash items. Then it is an operating activities section. See, it says it's operating activities. So any non-operating gains or losses must be cleaned up. So non-operating gains subtracted because gains would have increased my net profit, net income. So any non-operating. First you take care of non-cash. Now take care of non-operating. Any non-operating gain must be subtracted and non-operating losses must be added back. Non-operating loss added back, non-operating gains subtracted. All right, so that's non-operating adjustment. Then we do working capital adjustments. All right, operating current assets. operating current assets. Now, if those assets increase, except for cash, if they have increased, that means I've invested in those assets. Say my inventory balance has gone up, my receivables balance has gone up, all these current assets have gone up. That means money got stuck in these assets. I've made investments in these assets. So that means money was spent. So my cash flow would be lower, less than my net income, because my cash is stuck in my inventory. My cash is stuck in my receivables. My cash is stuck in my prepayments. In contrast, if my current liabilities have gone up, that means what? That means I saved my cash. I conserved my cash. See, like I hire you, but I don't pay you the full amount. So I hired you for say $12,000 a year, but I paid you only $5,000. So I owe you $7,000, but at the same time I saved $7,000. I have $7,000 of cash, which you could have had. You see? So increase in accounts payable and all those like wages payable, rent payable, electricity, utilities payable, increase in those items would have saved cash. So add those to your net profit, net income. And decreases should be subtracted. So decreases in those current liabilities should be subtracted. And then current assets, any increase in current assets should be subtracted, and therefore decreases should be subtracted. What did I say? Increases should be subtracted, therefore decreases should be added. Sorry, decreases should be added. So that's the working capital adjustment. So remember 3 adjustments for net income. I think I was speaking very fast. Too excited about cash flow statements. Net income, make 3 major adjustments. One is called accrual adjustment, means non-cash items must be added or subtracted, non-cash incomes subtracted, non-cash expenses added back. So that's accrual adjustment. Then you have the non-operating adjustment, means any non-operating gains must be subtracted, any non-operating losses should be added back. Non-operating means like you made some gain from selling your land. So that's a real gain, but that's not your day-to-day operations. So that has gone in to your net income, but it's not an operating income. See, let's say my net income is 0, or net income is $10,000. My operating income from my job is say $7,000 or say $5,000. So my operating income is $5,000, but my net income could be much more because I might have sold some of my assets this year. Or my net income could be even less or even negative, while I still get paid for my job, for my teaching. Why? Say university paid me $5,000, but then I lost $4,000 on selling my old car, my pre-owned car. So university gave me 5, but I lost $4,000 on selling my vehicle. So I'd be left, my net income is going to be only $1,000 while my operating income is 5. Okay, so our focus on this section is cash flows from operating activities. Therefore, nothing non-operating, nothing non-cash, because it's a cash flow statement. So non-cash has to go, non-operating has to go, and working capital adjustments must be made because any money got invested in working capital must be taken into account. So any money invested in working capital should be subtracted from my net income. So therefore, decrease in accounts receivable, increase in accounts receivable, increase in inventory, increase in prepayments, these should be subtracted, and decreases in all these should be added back. So add decrease in accounts receivable, decrease in inventory, decrease in prepayments, and vice versa. Subtract increases in all those. So the rule for current assets is totally opposite to the rules for current liabilities. So if decrease in current assets were added, then decrease in current liabilities should be subtracted. So increase in current assets should be subtracted. Therefore, increase in current assets, current liabilities should be added. All right. Well, you don't have to just memorize anything. You can just look at the slides as we go. Now I'm doing the breakups. You can see. So we start with our accrual adjustment. So net income is our base number. We start with our net income, and then accrual adjustments mean this. I've already explained it to you, so it's written here. Add non-cash expenses. So this is called non-cash adjustment or accrual adjustment. Accrual adjustment. Add that items like depreciation, amortization, impairments, write-offs. Also include depletions. Depreciation, depletion, amortization, like amortization of any franchise costs, amortization of, although goodwill is not amortized, but amortization of say, your um, trademark, amortization of many other intangible assets, copyright. All right. So those non-cash expenses should be added back, and that means any non-cash revenue should be subtracted. So minus non-cash revenue. Now, in our classrooms, we find we have a hard time giving examples on non-cash revenue, but I think this is a good one. Appreciation of the value of trading securities. Remember, well, this is beyond cash flow statement, but there are three types of securities in which companies invest. These are trading securities, available for sale securities, and held to maturity securities. So held to maturity and available for sale, any gain or loss on those, unrealized gains or losses on those, do not come to the income statement. Only unrealized gains or losses on trading ones do. Remember, if it was realized, if it was real gain, like if we actually sold our stocks and bonds, then that would not be non-cash. That would be non-operating. That would also come in the next adjustment, but that would not be a non-cash adjustment. That would be a non-operating adjustment. So what happens? Say you had some IBM stock that you didn't sell. IBM appreciated. So that appreciation, if IBM stock is your trading security, which it probably will be, so the appreciation of the value of IBM stock was included in your income statement as an income, but now we are getting rid of it because it's a non-cash income. It didn't bring any cash to my pocket. And then let's say you had some Facebook stock or some Apple stock. Those also appreciated and you sold. So you have actually, you have received the proceeds from sale of those stocks. But nevertheless, even though you have received the money, it's a non-operating income. The gain part or loss part is non-operating as long as you're not doing cash flow statement for an investment firm. So let's say for a university or for a hospital or for a doctor's place or for a lawyer's practice, everyone has investments in stocks and bonds, and many of them call them trading securities, like speculative securities. They invested in those stocks and bonds on a speculative purpose. So for speculative purposes, if there is any unrealized gains or losses, gains come in as in the income statement, losses also come in, but losses are subtracted. So we just have to do the opposite here to get to our cash flows from operating activities. So this is remember, this is the non-cash adjustment or accrual adjustment. Our second adjustment is non-operating adjustment. Here we add back any non-operating losses and subtract any non-operating gains, like the Facebook stock, as I said. You have actually made a gain on from selling it. So it's not an unrealized gain, it's a realized gain, but nonetheless, as it's non-operating gain, we have to get rid of it. So any gain from sale of stocks and bonds, or gain from sale of any say your assets, like you don't exist to sell your assets. So your assets, your inventory is up for sale, but your whole building is not up for sales. But occasionally you could sell part of your business. You could sell part of your unnecessary or unused or your non-current assets, like vehicles. We regularly sell our vehicles, old vehicles. So any gain or loss on those should be adjusted for. Gains should be subtracted, losses should be added back. So see here, plus non-operating expenses such as loss on sale of equipment, or minus non-operating gains or income such as gain on sale of land or gain on sale of investments. So these are adjusted for because these are non-operating. So non-cash adjustment, then non-operating adjustment. And finally, we have the working capital adjustments. In this working capital, do not include your cash or cash equivalents. So leave those, because that's what we are trying to explain using the cash flow statement. So cash and cash equivalents, any change in those should be left untouched. But all other operating current assets, remember, So when you say operating, just don't include operating cash. Include all other operating items like inventory, accounts payable, accounts receivable, prepayments, wages payable, taxes payable, insurance, interest payable, insurance payable, all those. All right. So again, we start with net income and then make these adjustments. So add decrease in operating current assets, such as accounts receivable, inventories. Add decrease, remember, decrease is added and increase is subtracted as far as current assets are concerned. And if you just remember this, add decrease in current assets, that means what would happen to increases? Increases will be subtracted. And then just flip this role for liabilities, current liabilities. Means add any increase in current liabilities and subtract decreases in it, in those. So the rule for current liabilities is diametrically opposite to the rules for current liabilities. Current assets follow one rule, current liabilities follow a different rule. All right. There you go. Add an increase in operating current liabilities such as accounts payable and accrued expenses, and minus decreases in those operating current liabilities. All right, so that gives us the operating cash flow. So now we have cash flows from investing activities. Let's take a pause. So operating cash flow is now calculated using both the direct and the indirect methods. Now let's get to the investing activities section. So what do you do in the investing activities section? Investing activities deal with non-current assets like investments in computer, equipment, land, building, and all those. So these are usually outflows, as I said at the beginning, but there could be inflows if you sell it. So any sale of land would produce inflow of investing cash flow. But remember, no matter whether there was a gain or loss, bring in the full proceeds. So if your land was, say, if you sold your land for $80,000, no matter how much the cost was, no matter how much gain you made or loss you made, the $80,000 is what you received, or net proceeds, assuming that you subtracted your commission and other things. So whatever you received, that proceeds should be included in the investing section as an inflow. So if you sold your land, if you sold your building, if you sold your house, if you sold any of, and even investments in stocks and bonds, bring in the full selling price, the sale proceeds. There should be the inflow. And then outflows like investment in land, investment in building, investment. So look for the exact purchase information. If you're, depending on how the question is designed, sometimes the professor, the textbook authors would tell you that last year we purchased land for $50,000 and equipment for $200,000. But others are notorious. They may not give you the actual purchase information. Rather, they would make you look at the two comparative balance sheets. They say, well, you work it out. So how do you work it out? If you, for example, if you see the last year, your land, for example, so land is the easiest. Say last year and this year, so 2019 and 2020. So land last year was $500,000. This year was $600,000. So what do you do? See, last year 500, this year 600. That means $100 worth of land has gone up. So land balance, how can your land balance go up? Revaluation is not allowed in the United States. So you haven't, this gain, this appreciation was not value appreciation. It was real purchase. So that means you would be able to, even though I didn't tell you that we made a purchase of land for $100,000, from a look at the comparative balance sheets, you would be able to figure it out. The last year's balance was $500. This year's balance is $600. So $100 must have been invested in those lands. But the trouble is with equipment, for example, say your equipment balance last year was $1,000, and this year your equipment balance was $1,200. So look at it. Last year was $1,000. This year is $1,200. So you can gauge that $200 worth of equipment has been acquired, but What if you sold some? Look at the accumulated depreciation. If I now include accumulated depreciation, say accumulated depreciation last year was $700 and this year was $900. So you can see the net amount doesn't show any change. So equipment net so this is tricky. Please take a look at this. Look at equipment. Last year was $1,000. This year it is $1,200. So it is true that $200 worth of equipment has actually been purchased, but the depreciation has eaten that $200. There were until last year, accumulated depreciation was $700, and it is now $900. So the net amount, net equipment is still $300. So if you look at the net amounts, you wouldn't be able to figure out whether any new acquisitions were made. And it would be more even, it could be complicated further if we sold some. But very important to look at the depreciations. And right now I'm assuming that we have not sold any of our equipment. So because if we sold, then the sold item would have taken its accumulated depreciation with it. So that would obscure some of my accumulated depreciation as well. That would make it even slightly more difficult. We can figure it out. So don't expect the question to be so forthcoming with you, that they're going to tell you that, look, we purchased $200 worth of equipment and $100 worth of land. So what you see here, say again, last year was $1,000, this year is $1,200. So the gross amount gives you some idea. And although the net amount is still $300, that is $300 because depreciation was a couple of $100. So $700 last year is $900 this year. But it's still, although the net amount is the same, $300 and $300, we have actually purchased equipment worth $200. All right, now let me make it slightly more complicated. Let's say last year, equipment was $1,000, true. And accumulated depreciation was $700. So net amount was $300. And let's say we purchased $200 worth of equipment, but also sold $100 worth of equipment. Purchased $200 worth and sold $100 worth. So our new balance would be $1,100. But we know privately that we actually purchased $200 worth of equipment and then sold $100. All right. So our balance left over is now $1,100, and the one that is sold, so the $100 one that has taken $80 worth of depreciation with it. So although my regular depreciation was $200, so my depreciation would be $700 plus $200, which would be $900 minus $80. So my accumulated depreciation would be $820. Now you'll see this is now your trivia. So look at it carefully. Equipment last year was $1,000. We purchased $200 worth. So 1,000 became 1,200, and then we sold one of the old ones. That has brought it down to 1,100. It's gone up by 200, then came down by 100. So it's now $1,100. Depreciation was actually in the income statement. So your income statement is very critical here. Your accumulated depreciation difference is tricky, is deceiving. It is deceptive. It is deceptive because it doesn't show you the accumulated depreciation included in the item sold. Accumulated depreciation balance shows what's in store. It shows the accumulated depreciation of the items that are still in our business. The items that have left us, the items that we threw away, they took with it their accumulated depreciation. Like when you leave, you take your, like when they offload us from flights, they offload our luggages as well. So when you retrieve, when you decide not to go back, or you don't show up after having the boarding pass, so the guys would have put your luggage in and all your bags already in, and then you don't show up, they keep calling and frantically look for you, but still say you're too busy doing duty-free shopping, or got engaged in phone calls, or in the washroom, or fell asleep. So they have to take off your bags from the flight. Anyway, so if the items that are sold, even though your bags are not always taken off, the accumulated depreciation of the items sold are always 100% cases they're taken off. So the items sold, the item that is sold was $100 one, $100 book value one, but that had $80 of accumulated depreciation in it. So from my $700 of, with my $700 of accumulated depreciation, my income statement shows $200 of depreciation this year. So 700 plus 200 makes it 900, minus the 80 makes it 820. So you can see the balance now, 1100 minus 820 is 280. So now what happened here? $300 balance, last year balance was 300, this year's balance is 280. So it looks like we sold, we have not acquired any equipment, we rather sold. If you look at just the net figures, if you do not look at any of these, you'd think that $200 worth of items have been disposed of. But the real story is that was 1,000 plus 200, making it 1,200, minus 100, making it $1,100. So that's how the beginning balance, that's how the book value changed from 1,000 to $1,100. But the accumulated depreciation changed by in a different way. $700 was the beginning balance, plus 200 makes it 900, minus 80 makes it $820. So we would now, in the investing section, we would say purchase of equipment $200. The sale of equipment, depending on how much that one was sold, say the $100 worth one that had $80 of depreciation, accumulated depreciation. So the book value was actually only $20. Let's say that was sold for $90. So we made some gain. So we bring in the whole $90 there. So purchase of equipment, cash outflow would be $200, and sale of equipment would be 90. Or it might have been sold for nothing, say $0, then there would be no proceeds. Or it might have been sold for only $5, then just bring 5. Loss or gain would be dealt with in the operating section, or would have already been dealt with. All right, so that has to be taken into account. So it could be a simple case of just purchase of from 1,000 to 1,200, or it could be a more complicated case where you will have both purchase and sale of those assets. All right, so our investing section here, the more complicated one would show $200 of outflow and maybe $10 of inflow. And all the losses or gains would be dealt with in the operating section. So take a careful look. All right. So that brings us to our investing section. So inflows would be proceeds from sale of non-current assets, such as sale of land, sale of business segment, sale of a business segment, sale of an old equipment or more old equipments. And then outflows would be investments in similar assets, purchase of land, building, acquisition of another business, etc. So the actual number, don't worry about gains or losses. If you have actually sold, like this lamp, my table lamp, if I sold it for say $5, even though my book value was say $7, I sold it for how much? I sold it for $5, so bring in the 5. If I sold it for $2, then bring in the $2 as an inflow. Now the other you can see there's another table lamp here. So let's say I bought this one for $15. So that's an acquisition. So that would be an outflow of $15. Investing outflow. Purchase of equipment, purchase of table lamps. If it was purchased for $15, then it should be reported at 15. The other one was sold for $2, we reported as $2. All right. Next is cash flow from financing activities. So financing will have inflows, and like investing and operating. It will have inflows as well as outflows. So inflows come from sale or issue of stocks and bonds, or new loans, any other borrowing. So if you have those, there will be an inflow. Now, when I say if you have those, you have to carefully look at the additional information or the comparative balance sheets. The comparative balance sheet is more reliable source, but some textbook writers, sometimes your professors, quite friendly, quite user-friendly or student-friendly. So they'll tell you that we repaid $20,000 worth of our long-term notes, or we paid off this mortgage, we paid off this bond was retired, or this bond was replaced by another bond. So then they're going to tell you what actually happened, and they'll say, well, last year we issued common stock, 20,000 common stock for $15 each, or 10,000 preferred stock for $80 each. So they're going to tell you what they have done. But if they do not, then use the comparative balance sheet. Just one point, as I said, if a bond was replaced by another bond, then it doesn't have any cash flow effect. It's a significant non-cash transaction, like you swapped your land for a building, or you sold, like you paid off some of your loans with some of your assets. In that case, it's neither an inflow nor an outflow. It would be a significant non-cash transaction. But nevertheless, that's beside the point now. So we have proceeds from sale of common stock, preferred stock, bonds, or other borrowings. And then outflows would be buy back your own stock, like stock repurchase, or retire or repay bonds, repay other long-term loans, and pay dividend. So when it comes to all those repayments or other things, the exact amount, the cash amount that you actually used to repay a loan. So if a loan repayment involved any penalties, then that should be included too. That the penalty should be included. Or if you have used, say, more money, less money, whatever money you used, the actual amount that you spent, the actual cash used, must be reported. All right. So your stock price could be, say, $13 each, but when you bought it back, you might have paid $15. Then that 15 should be included here. And paying dividend, you may have announced, say, $20,000 of dividend, but you didn't pay all 20,000, or you may have paid actually more than 20,000. So the exact amount that you paid should be included here. So when you say the exact amount, how can it be different from the amount announced? It can always be different. Let's say I announced $20,000 worth of dividend, but not every shareholder was cashed their check. So a lot of checks might have returned. There could be unclaimed dividend, or I might not have had the cash to pay the dividend yet. So that dividend might have been announced, but it may not have been paid yet. So that amount would be reported as dividend payable. What if the dividend was announced at the very fag end of the year? So you have announced the dividend, that's a payment, but not a payment. That's an announcement, not a payment. So the full amount would be sitting as dividend payable. It's possible. But usually there would be some amount that sits as dividend payable all the time. So you have to look at your beginning balance of dividend payable and ending balance of dividend payable, and the dividend actually announced. So if you have announced that $20,000 worth of dividend and there was no change in beginning or ending balances, then the exact 20,000 was paid. But if there was an increase in dividend payable, that means we paid less amount. See? So you announced $20,000, but you paid only 18. So that means the $2,000 that you didn't pay would show up as dividend payable, or as an increase in dividend payable account. All right. So we have to take those into account. All right. So now we have seen the actual mechanics of the preparation of cash flow statement. We've seen how operating cash flow is prepared using the two methods, the direct and the indirect method, and then the investing cash flow from investing activities as well as from financing activities. Okay, so now here's a practical example. This is we have an income statement and two balance sheets, comparative balance sheets. All right, so the income statement has typically, all the typical items. So sale of 1.18, I don't need to, reiterate the amounts or read out the amounts. They're already there. So I hope they're in the recorded in the video. So sale of $1.18 million, cost of goods sold of 790,000, gross profit of 390 for depreciation, and other operating expenses. See, depreciation is separately reported. Then other operating expenses, total operating expense, operating income 187, other revenues and expenses, gain on sale of land, interest expense, income from income taxes and net income. So net income is $108,000, while our operating income is $187,000. So look at it. Net income $108,000. You're going to use it in the indirect method. So that's our income statement. We have comparative balance sheets here. You can see changes in cash, accounts receivable. So cash has gone up by 71.5. Accounts receivable has gone up by $9,000. Inventories have gone down. Then the rest are non-current assets. Land has gone down. Building has gone up. Accumulated depreciation has gone down too. See, building has gone up, but accumulated depreciation has gone down. That means some building would have been sold. Then we have the liabilities, current liabilities and non-current liabilities, and equity. So look at common stock. Yes, there's some issue of new common stock. Paid in capital in excess of par, yeah, that has gone up too. Retained earnings, it's gone up by $80,000. See, our profit has gone up by 108, but retained earnings has gone up by $80,000 only. So that means the other 28 was dividend. So your profit, your retained earnings would have gone up by 108, but would have gone down by 28 because of dividend. So that's why the net change is only $80,000. Well, so that's our comparative balance sheets. So these are the cash flow statements. I'm not doing the whole thing on camera, but what we have shown here is that first the indirect method. So we started with net income. As I said, net income was, look at it, net income was $108,000 at the bottom of your screen, $108,000. Then what would you do? We go through all the non-operating and non-cash. So I can actually tell, right from here, from the income statement, and then we go back and see whether what I said was right or not. So our base number is $108,000. So plug it in, $108,000. Let's try to do it real time. Net income of $108,000. And then what's your depreciation? Depreciation is $7,000. So add depreciation, $7,000. And then gain on sale. So less gain on sale. You have to subtract it. Subtract the $12,000. The depreciation adjustment was because it was non-cash. The gain on sale of land is adjusted because it's non-operating, and then interest expense is okay. And then we need to do the working capital adjustments now. Working capital adjustment, we do accounts receivable has gone up, so minus increase in accounts receivable, $9,000. Inventories have gone down, so a decrease in inventory, $8,000. In accounts payable, it's gone down, so minus decrease in accounts payable, $3,200. Accrued expenses gone up, so plus increase in accrued expenses, $2,200. Decrease in income tax payable. Income tax payable, $500. Don't touch the dividends payable. All right, so that looks like that's all that we have. Get to operating section. Let me see. What I have is 108 plus 7 minus 12 minus 9 plus 8,000 minus 3,200 plus 22 minus 5. Perfect. So we have net cash flow, CFO, cash flow from operating activities of $100,500. All right, you can see my items and compare it with their items. You can see it. So it doesn't take more than a couple of minutes. If you know what you're doing, if someone gives you an income statement and a comparative balance sheet, two balance sheets, comparative balance sheets, then you don't need much of any other information. The property, plant, and equipment would be critical if there's any sale. All right. So now let's get to investing section. For investing section, we just focus on the comparative balance sheets. See, what you hear is that what you see here, we look at our land. So land has gone up, land has gone down by 45. And this, so land was sold. So book value is 45, and then go back to the income statement to see how much they gained or lost. So there was a gain on sale of land of $12,000. So they book value was 45, but then there was a gain of 12. So $45,000 worth of land was sold for 57. That would be the amount, I would assume. See, gain on sale of land is $12,000. The book value was 45. So 45 plus 12, the actual proceeds was $57,000. And the building has gone up by $60,000. And then the accumulated depreciation has gone up. Last year's 58,003, and this year 65,003. So accumulated depreciation has gone up actually by $7,000. So that is exactly the same as we see in the income statement. So that's our depreciation expense, $7,000. You can see here, the income statement says $7,000, and the change in accumulated depreciation is also exactly $7,000. So that means no. So I will draw my previous comment. That means no equipment, no building or equipment was sold, was disposed of during this period. Because if it was, then that would have disrupted our accumulated depreciation balance. All right. So this is the same as the income statement amount. So that means nothing was sold. All right. So building has gone up by 60. That means acquisition of a building was $60,000. So we have found two items now. A building was acquired for 60 and land was sold for 57. I can't see anything else in the investing section. Land, building, and I cannot see anything else. All right, so let's look at the investing section. Cash received from sale of land. Yeah, I thought 57, but they looks like there was a one, they purchased one, they sold one. So they actually received not 57, the net amount was 57, but they actually paid, they purchased a new land as well. So we need to look at the additional information then, because the comparative balance sheet would not show us any more than the net change. So the net change in land was $45,000, and then the net gain was 12. So I thought 45 plus 12 is 57, and $57,000 was what they received. But the additional information somewhere, they would have told us that another land was actually purchased. So they purchased the land for 15, and that means the one they sold was for more, was $72,000. And then there was the historical cost was only 60. So $60,000 worth of land was sold for 72. So the gain was still 12, but 60. Why don't you see a change of $60,000 in the on the balance sheet? Because $45,000 has gone out and $15 has gone has come. I mean, $60,000 has gone out and $15,000 has come in. So that's why the real exit, the real decrease looks like only 45. The actual decrease was actually 60. So $60,000 worth of land has gone out and $15,000 worth of land has come in. Anyway, so that's why there are three items here. Sale of land 72, then purchase of land 15, and purchase of building was 60. So that's our investing section, has a net outflow of $3,000. And then the financing section, we again easy, we can just look at the equity section of the balance sheet. What does it say? It says you have issued common stock. Your common stock account last year was $16,000. This year is 24. So $8,000 worth of common stock was issued, but it has, when you issued, you sold it for much more than $8,000 because your paid in capital in excess of par has gone up from 80 to 120. So there's a $40,000 increase. So 40 plus 8. So total proceeds from sale of stock was $48,000. It would have been 48. See here, cash received from sale of common stock was $48,000. And then look at our bonds. Look at the other item, the liabilities. Total bonds payable. Bonds payable last year was 150. This year it is 100. So that means $50,000 worth of bond has gone down. So it would have been repaid. So that's the 50. It's sitting here. Cash paid to retire bonds payable, $50,000. And the dividends. We know the dividend announced was 28, but the dividend actually paid was less because dividend payable balance has gone up by $4,000. So dividend payable going up means you didn't pay all your announced dividend, all the dividend that you announced. You announced $28,000 worth of dividend, but you paid $4,000 less. So you actually paid $24,000 worth of dividend. So that's what is featuring here in the financing section of the cash flow statement. So cash paid for dividends is 24. So net cash flow used in financing activities is 26, used in investing activities was 3, and received from operating activities was 100,500. All right. So if you combine the three, remember positive $100,500, that's operating inflow. Then investing outflow was 3, financing outflow was 26. So the net increase in cash was $71,500, and that's exactly what the difference was between the two cash balances. You can see here, the cash last year was 26, this year it is 97.5. So the net increase in cash was $71,500, and that is the sum total, the grand total of all three activities, also $71,500. All right, so you add the beginning balance, you find the ending balance. You see what I mean? Like you have seen operating cash flow, inflow, operating cash inflow, then investing and financing outflows. But the three combined gives you a net inflow of $71,500. With that, you add your beginning balance. So your beginning balance plus these increases should be equal to your closing balance or ending balance of cash, which matches with our question in the comparative balance sheet. All right. So that was the indirect method. Well, the investing and financing sections don't have any variance. There's only one way to do those two, but the operating section can be done in two different ways. And now the final slide here is the direct method of the operating section. Does the operating section using the direct method. All right. So how do you do? We do the well, we haven't done the work using the direct method, but I can do it for you. Easy, but I don't think, I mean, we've already spent, I think, more than an hour in this one video. So I'd like you to try it yourselves. What you have to do is find out cash received. So let me do just at least 1 or 2 items for you. So let's start with cash received from customers. So how do we find it out? cash received from customers. We said we start with sales. So sales revenue, and sales revenue was how much? Go back to the income statement, is 1,180,000. So $1.18 million. And let's look at our accounts receivable. Has it gone up or down? Accounts receivable has gone up. So minus increase in AR by only $9,000. Not a problem. Subtract it. So that would be $1,171,000. So this is one of the 4 questions. Cash received from customers. Sales minus increase in accounts receivable. Okay. The next item would be payment for purchases, but we need to do no purchases first. So our purchases would be equal to COGS. So cost of goods sold, which is $790,000. With COGS, we adjust for inventories. So let's see whether inventory has gone up or down. Inventory has gone down. So if inventory goes down, that means we purchase less. So minus decrease in inventory, and that was by $8,000, which has gone down. So that means our purchases was 790 minus 8 gives you $782,000. So now with purchases, we adjust for accounts payable changes in accounts payable. So accounts payable have gone down by $3,200. So accounts payable going down means you paid more. So add decrease in accounts payable by $3,200. All right, so if we add it, we'd get $785,200. So payment for, so we've already got to the backbone of it. We've already broken the backbone of the question. So our cash received from customers was this, and now cash paid to suppliers is this. So this is our cash paid to suppliers, or cash paid for purchases. And then cash operating expense or expenses. So our other operating expense $196,000. Other operating expenses $196,000. And let's look at any change in accrued expenses. Accrued expenses for operating expenses has gone up. So accrued expense going up means we paid less amount. So minus increase in accrued by $2,200. So 196 minus 22 is 193.8. That's our cash operating expenses. So we've got 3 important numbers, and then I think life's now really easy because we just need interest paid and income taxes paid. All right, so I've actually got my amounts. I have cash received, from customers, 1171. Then cash paid, suppliers, 785.2, and cash operating expenses, 93.8. Now let's just find out how much interest we paid. Interest expense is $8,000, and there's no interest payable. You can't see any interest payable here. So interest paid, is 8,000, and taxes paid. Income tax expense was 83, but income tax payable has gone down by $500. So income taxes paid, we must have paid more money than our due tax. So income taxes paid, how much was the accrual expense or income statement amount? The income statement says income taxes expense was 83, and then the payable has gone down to 83.5. Remember, folks, we must have paid more than what we owed. That's why our taxes payable comes down. So nothing else. This should be our cash flow from operating activities. I'm having a heart is beating really hard. I'm trying to solve it on camera. So cash received from customers. You can see all the items. Interest, income tax. This includes all the operating expenses. This is cash paid for purchases or cash paid to suppliers. All right. So 1171, then minus 780, 5,200, minus 193,800, minus 8,000, minus 83, 500. 1, 0, 0, 5, 0, 0. How much was the, see? How much was it? 100,000 and 500. And my calculator also has, can't see it. It has 100. So net operating cash flow is so this is the direct method, and the direct method needed these workings. So I had to do the workings, these workings first. Had to do these workings, find out cash collected from customers, cash paid for purchases, cash operating expenses, and then income taxes paid and interest paid. So the OCF is the same under the direct method as under the indirect. So let me show you again. Stop the, yeah. So this is how I did it under the direct method. So this is OCF. Operating cash flow using direct method. Cash received from customers is sales minus increase in accounts receivable. So that's the cash received from customers. Then from COGS, we did the inventory adjustment to get the purchases, and with purchases, we did the accounts payable adjustment to get to cash paid for purchases, cash paid to suppliers. So this is an inflow, this is an outflow, and cash operating expenses, the income statement number, plus or minus the accrued amount. So there's the cash actually paid for operating expenses. So we have this inflow, one outflow, second outflow. Remember, one inflow, one outflow, second outflow, and then two more, interest paid and taxes paid. Interest paid was exactly the income statement amount because there was no interest payable or accrued interest, and taxes paid was slightly different because the income statement shows 83,000, but the balance sheet shows that we have reduced our payable by $500. So that means we paid actually more. $500 more. And once we added these numbers, we got the same OCF as we did under the indirect method. This is the indirect method. Operating cash flow under the indirect. This is the indirect method. This number, magic number. So you can see it doesn't take too long to at least solve typical, this is, well, in intermediate accounting, the problems are slightly more complicated, but nothing is more complicated than the scheme than my PowerPoint. And my PowerPoint includes like depreciation, amortization, impairments, write-offs, appreciation of the value of trading securities. And if you have available for sale, or although appreciation, depreciation of the value of held to maturity securities are not dealt with at all and recognized, but available for sale securities are, but that goes to the equity section. It doesn't come to income statement, so it doesn't need to be adjusted with net income to get to operating cash flow. All right. So I think, and I hope that you've enjoyed the discussions. And if you have any problems, then please write to me. And what is important is to practice some of the problems at least. Practice some problems. I have given you a couple of problems, the question papers on Blackboard, but I hope you listen to this video. And anyone who is interested in cash flow statements, any of my students, colleagues, well, I don't think my colleagues would find it that useful, because they can make much better and more effective presentations, and they know way better than I do. But my students and friends, anyone's interested in cash flow statements, may benefit from this video. And if you do, then I'd find my work worth the time and energy. All right. Enjoy the rest of the rest of your weekend. Tomorrow is Sunday, or it's already early morning of this 29th of November, Sunday. All right. I hope to see you again in my next video. Bye-bye.